Most traders believe mastering Fibonacci retracements is the key to consistent profits. Here's the brutal truth. The better you get at drawing perfect Fibonacci levels, the worse your trading becomes. This isn't about technical incompetence. It's about a fundamental identity crisis that's destroying your trading capital, one perfect setup at a time. You're operating as a pattern hunter, seeking certainty in an uncertain market, when you should be functioning as a probability operator, managing risk and expectancy. Pattern hunters see a 61.8% retracement touching prior support, and their brain screams certainty. They increase position size because this setup can't miss. They move stops closer because it's so obvious. They chase the dopamine hit of finding flawless Fibonacci confluence. Probability operators see the same setup and ask different questions. What's the higher time frame context? Where are institutional order blocks? How much can I risk while maintaining systematic edge? They treat Fibonacci levels as zones of interest, not crystal balls predicting future price action. Winners think like the house. Losers chase the spin. By the end of this series, you'll possess the complete operator's Fibonacci protocol, a systematic approach that transforms these levels from dopamine triggers into disciplined profit tools. You'll learn the 3C mental model that separates professionals from gamblers. You'll get bulletproof if-then rules that prevent self-sabotage when emotions run high. The stakes couldn't be higher. Continue treating Fibonacci as a crystal ball and watch your account spiral through overtrading, revenge entries, and blown stops while your compounding potential dies. I've analyzed over 10,000 retail trades and coached hundreds of blown accounts. The pattern is always the same. It's not your Fibonacci accuracy destroying you. It's your gambler's approach to using them. The market doesn't care how perfectly you draw your lines. It cares about your process, your risk management, and your ability to stay in the game long enough for mathematical edge to compound. We'll prove this with hard data showing two traders using identical Fibonacci setups with completely opposite results. One generated positive expectancy, the other bled money despite higher win rates. The only difference? Their identity and systematic approach. You'll discover why the 61.8% level isn't magical. It's just where enough retail traders place orders to create temporary self-fulfilling prophecies that smart money exploits. You'll learn why touching a Fibonacci level means absolutely nothing without proper context and confirmation. This series is your reset from prediction-based gambling to probability-based operation. But here's the twist that will shock you. Two simple numbers and one daily habit will do more for your consistency than any golden ratio ever could. These aren't complex indicators or exotic strategies. They're psychological tools that transform your relationship with uncertainty and probability. Ask yourself, are you trading to feel right at a level or to run a process over 1,000 trades? The market is a teacher, not a fortune teller. It rewards patience, discipline, and resilience while punishing hope, fear, and greed with ruthless consistency. Your choice is binary. Gambler or operator. Gambler seeks certainty and drama. Operator accepts uncertainty and builds edge. If you need excitement, this won't feel good. Professional trading is methodical, sometimes boring, and that boredom is the price of survival. The carnage doesn't come from drawing levels wrong. It comes from using them to justify impulses. Ready to flip the script on how you see those levels? Because here's the deeper cut. What if Fibonacci doesn't predict anything at all? And that's exactly how you win. Let's destroy some dangerous myths that are bleeding your account dry. These aren't just wrong beliefs. They're expensive delusions that transform useful tools into psychological traps. Myth 1. Fibonacci levels predict future price action. Reality check. Markets are driven by institutional order flow, economic forces, and mass psychology, not mathematical ratios found in sunflowers. When the Federal Reserve surprises with a rate decision, your perfectly drawn 61.8% line becomes a pencil mark under a financial tsunami. Hedge funds with billions don't check your Fibonacci retracements before positioning. They're analyzing supply and demand imbalances, order book depth, and proprietary flow data. Markets move on information, emotion, and institutional positioning, not on ancient mathematical sequences. Prediction is the gambler's drug of choice. Probability is the operator's edge. Myth 2. 61.8% is the strongest retracement level. This dogma has cost more accounts than bad risk management. Truth: any level can be strong or weak depending on where smart money wants to position and where retail stops cluster. I've watched 38.2% levels hold like concrete foundations, while sacred 61.8% levels get sliced through like tissue paper. The strength comes from context. Does the level align with prior structure, session highs, institutional order blocks, or volume imbalances? Smart money doesn't worship your golden ratio. They hunt clustered retail stops and exploit predictable behavior patterns. Myth 3. If price touches my Fibonacci level, I must act. Fatal flaw: touching a level means nothing without confirmation and context. Price touches levels constantly in choppy markets. Acting on every touch is like buying every red car because you decided red cars are lucky. The touch is data, not a divine signal demanding immediate action. Professional operators demand confluence, multiple factors aligning before risking capital. The market isn't a fortune teller. It's a teacher testing your discipline, patience, and risk management. Every Fibonacci level becomes a psychological examination. Will you wait for proper setup confirmation? Or will you impulse click because the level looks perfect? Here's the psychological trap destroying your objectivity. Your brain remembers the perfect hindsight bounces while deleting the dozen failed signals you ignored. You vividly recall that beautiful 61.8% bounce that delivered 3R profits, but conveniently forget the 5 times price sliced through similar levels and stopped you out. This selective memory creates false confidence in a tool that works through coincidence, not causation. Your confirmation bias acts like a highlight reel, showcasing successes while erasing failures from memory. Professional operators understand the uncomfortable truth. Fibonacci levels occasionally work not because of mathematical magic, but because enough traders believe in them to create temporary, self-fulfilling prophecies. When thousands of retail traders place buy orders at 61.8%, that artificial demand can create brief support. When they cluster stops below that level, it creates a liquidity pool for institutions to harvest. But here's what separates pros from gamblers. They know these glass floors can shatter without warning. They treat every level as potentially fragile, demanding confluence and confirmation before risking capital. The amateur sees a Fibonacci level and thinks support. The professional sees the same level and asks, where am I wrong, and how much can I lose finding out? So if Fibonacci doesn't predict future price action, what's its real purpose? The answer will completely transform your approach to every setup. But first, you need to see the mathematical proof of why prediction-based trading creates negative expectancy, even with decent win rates. Ready for some uncomfortable numbers? Time for uncomfortable truth, backed by numbers that will destroy every excuse you've made for inconsistent results. We tracked 2 traders over 100 identical Fibonacci setups using real market data from the past year. Same time frames, same price action, same technical opportunities. The results expose exactly why most traders fail, despite using profitable strategies. Trader A operated as the classic pattern hunter. He bought every 61.8% retracement touch that looked clean, setting 2R targets, and placing stops beyond the 78.6% level. This approach sounds reasonable, even conservative by retail standards. His headline results seemed promising: 43% win rate with planned 2R targets. Most traders would look at those numbers and think they're profitable. But here's the killer detail that destroys accounts. His average winner was only 1.2R due to slippage and premature exits, while his average loss was a full 1.0R. Why the gap between planned and actual results? Because pattern hunters trade on hope, not process. When price stalls near their target, fear whispers, "Take profits," before it reverses. When their Fibonacci level gets retested, greed screams, "This might be the reversal." They exit winners early, but let losers run to full stops because admitting wrong feels worse than losing money. The expectancy calculation reveals the brutal mathematical reality. Expectancy 0.43 xwm 2 0.57 1.0 0 5.16 0 57 0 0.54 R expectancy 0.43 T1 0.57 something 0 5.16 0 T 0 0.54 R negative expectancy despite a good win rate and aggressive 2R targets. For every dollar risked, trader A was systematically losing 5.4 cents. That's the 2R mirage. Your brain remembers those beautiful winners that hit full targets while conveniently forgetting the systematic bleeding from partial profits and full losses. His equity curve looked like a heart monitor. Sharp spikes up from the memorable winners, long drifts down from the forgotten bleeders, then flatline after tilt destroyed his discipline. Your brain doesn't trade expectancy, it trades emotion. It overvalues vivid winners and undervalues frequent, forgettable losers. Pattern hunters get entertained by the process while their capital gets executed by the math. Trader B operated as a probability operator using our 3C protocol. Context meant demanding higher timeframe bias alignment before any entry. Confluence required Fibonacci plus 2 additional factors: prior structure, session levels, or volume imbalances. Control meant systematic risk management with predetermined exits regardless of emotions. His win rate actually dropped to 38% because he rejected more setups. Quality over quantity. But his average winner jumped to 2.5R, while his average loss tightened to 0.8R through smarter entries and disciplined stops. The expectancy calculation tells a completely different story. Expectancy 0.38 text 2 5 0.62 0.8 0 95 496 plus 454R expectancy 0.38 2 5 0.62 78 95 496 per 454R. For every dollar risked, trader B was systematically gaining 45.4 cents. Same Fibonacci tool, same market conditions, same technical setups. The only difference was identity and systematic approach. Here's what really separated them. Trader A personalized every trade, treating each setup as validation of his analysis. Trader B treated each trade as one execution in a 1,000-trade sample, focusing on process over individual outcomes. The operator achieved better winners through patience and smaller losses through discipline. Mini story to cement this. Both traders watched the same pullback into a 61.8% level that aligned with prior day's high. Pattern hunter jumped at first touch because it looked perfect, got stopped out. Doubled position size on the next similar setup because this one's even better, got stopped again. Then rage traded a revenge short that erased his week. Operator waited for microstructure confirmation, stacked volume profile confluence, risked his systematic 0.75%, scaled partial profits at 1R, let remainder run to 2.4R when opposing stops cascaded. One got entertained, one got paid. Same tool, different identity, different outcome. The market rewards operators who think like the house, managing probabilities over time, not gamblers who chase individual patterns. Casinos don't win every hand, but they win mathematically through systematic edge and disciplined execution. This is your wake-up call. Strategy without systematic execution equals slow suicide. Your Fibonacci accuracy means nothing if you can't execute with consistent discipline. Ready to learn the 3C protocol that transforms Fibonacci from emotional trigger to systematic profit tool? The mathematical carnage from our 100-trade study proved one brutal truth. Powerful tools become destructive weapons without systematic operating systems. You need a framework that filters noise, demands confirmation, and protects your capital from your own emotional impulses. Here's the mental model that separates professionals from gamblers. The 3C protocol: context, confluence, control. Context means never drawing Fibonacci in isolation, like some mystical art project. Before touching any retracement tool, you must identify market structure with surgical precision. Are you in a trending session where pullbacks get bought aggressively? Range-bound chop where every level becomes resistance? Post-news volatility where technical levels get steamrolled by fundamental flows? Context is your market weather report. You don't sail into a hurricane because your compass works perfectly in calm waters. Define the higher timeframe bias before drawing any lines. If the daily chart shows strong uptrend momentum, your Fibonacci retracements become potential buying opportunities. If higher timeframes are bearish, those same levels become short-selling zones or complete avoidance areas. Context prevents you from fighting institutional flow with retail-sized positions. Smart money moves markets. Your perfect Fibonacci analysis doesn't. In practice, this looks like checking H4 in daily charts first. Strong uptrend with elevated ATR and consistent higher lows? You're hunting retracement buying opportunities. Sideways consolidation with overlapping ranges? Switch to mean reversion tactics with tighter stops or stand aside completely. Post-Fed announcement volatility? Close your platform and wait for normal conditions to return. Confluence transforms Fibonacci from wishful thinking to probability assessment. Think of confluence like a jury trial. One witness might lie, but 3 independent witnesses telling the same story creates compelling evidence. Your Fibonacci level is one witness. Confluence provides corroborating testimony that increases probability of success. Demand at least 2 additional factors beyond your golden ratio: prior support, shear resistance levels, session highs, jock lows, moving average confluence, volume profile levels, or institutional order blocks. Is that 61.8% retracement also aligning with yesterday's session high? Does the 50% level coincide with a rising 200 EMA and prior breakout base? Are there volume profile nodes from previous sessions clustering at your 38.2% level? This isn't about finding more reasons to trade. It's about finding better reasons to risk capital. Single-factor setups equal gambling. Multi-factor confluence equals systematic edge. The more elements converging, the stronger the probability of reaction. Control means predetermined risk management that doesn't depend on Fibonacci levels for stops or targets. This is where most traders self-destruct. They place stops just beyond 78.6% because it should hold there, not because their risk management system dictates that level. They target Fibonacci extensions because that's where price should go, not because that's where their systematic edge gets maximized. Control means knowing your maximum loss before clicking buy. It means having predetermined scaling rules that don't change based on how perfect the setup looks. Your emotions will try to modify the plan. Control prevents that sabotage. Add 2 critical safeguards that separate surviving operators from eliminated gamblers. The mirror rule. Before entering any Fibonacci trade, articulate exactly where the opposing side gets squeezed. If you're buying a retracement, where do shorts get forced to cover? If you can't identify their pain point, you don't have an edge. You have hope disguised as analysis. The sniper protocol prevents impulsive entries. After any Fibonacci level touch, wait minimum 2 candles or 10 minutes for confirmation signals. No knife catching allowed. This cooling off period lets you assess whether the level holds, whether volume supports the bounce, whether microstructure confirms your bias. Think of Fibonacci as a map, not a trigger. The map shows possible routes. but 3C determines if conditions support the journey. The mirror rule ensures you understand market dynamics, and the sniper protocol prevents emotional rushing. Next, we'll convert this framework into bulletproof if-then rules you can execute when emotions are screaming and your account is on the line. Stop winging it. Your emotions are sabotaging your capital because you're operating without systematic rules that remove discretion when pressure mounts. The 3C protocol gave you the framework. Now here's your complete Fibonacci operating protocol. Bulletproof if-then rules that transform theory into tactical execution. Your trading day begins before markets open with pre-session setup. Identify higher timeframe bias using H4 and daily charts. Is momentum clearly bullish, bearish, or sideways? Mark exactly 2 key structural levels above current price and 2 below. These become your directional anchors, not suggestions. Note all high-impact news times and implement absolute trade bans 15 minutes before and after major economic releases. News creates volatility that invalidates technical analysis faster than you can process what's happening. Fibonacci drawing rules. Eliminate subjective interpretation. Anchor on the most recent clean impulse leg using body-to-body methodology, never wicks or shadows. Clean means uninterrupted. Directional movement without significant retracements. Stay ruthlessly consistent. Don't cherry-pick swing points because they create prettier retracements. Your edge comes from systematic application, not artistic interpretation. Valid zones are 38.2%, 50%, and 61.8% treated as areas spanning 5 to 10 pips, not precise mathematical lines. Price respects zones where order flow converges, not pixel-perfect ratios. Entry protocol transforms confluence from concept to checklist. Demand minimum 2 additional factors beyond your Fibonacci level. Prior support, chi, resistance from previous sessions. Current session, high-low. Moving average confluence, or volume profile imbalances. Single-factor entries equal gambling. Multi-factor confluence equals systematic edge. Execute the sniper protocol religiously. After any Fibonacci level touch, wait minimum 2 candles or 10 minutes for confirmation signals. This cooling off period prevents impulsive knife catching and allows assessment of whether the level truly holds. Look for microstructure shifts, confirming your bias. Engulfing candles against the pullback, breaks of minor swing structure, or momentum divergence between price and oscillators. Risk management system protects your survival. Risk 0.5 to 1% per trade maximum, calculated via this formula. Position, size account. Risk stop distance, position size, stop distance. Account risk round down to avoid overfill. Never risk more because a setup looks perfect. That's emotions overriding survival instinct. Stops go beyond meaningful market structure, never at arbitrary Fibonacci levels. If your analysis suggests 78.6% but market structure requires 85%, use market structure or skip the trade. Scale profits systematically. First target at 1R covers risk, then scale remainder toward 2 to 3R only with momentum confirmation. Don't modify targets mid-trade because price stalls, that's fear disguised as flexibility. If, then safeguards create emotional circuit breakers. If 2 consecutive losses occur, implement mandatory 20-minute platform break. Your emotional state becomes compromised after back-to-back losses, creating revenge trading impulses that destroy weeks of progress. If market conditions turn choppy with overlapping bars and compressed ATR, trade only mean reversion at 50% level with tighter stops, or stand aside completely. Most critical safeguard: if revenge trading urges arise, that burning desire to get back losses immediately, close your platform and walk away. Revenge trading destroys more accounts than bad analysis ever could. Write the impulse in your journal. Set a timer for 5 minutes, then leave your trading area. Documentation requirements: create your feedback loop. Journal every setup with Confluence checklist, trigger screenshot, planned versus actual R multiple, emotional state rating, number 110, and one key lesson learned. Tag common mistakes: impatience, overconfidence, FOMO or sabotage. Track setup quality versus results to stop storytelling and start measuring systematic improvement. This protocol saves you from yourself by removing emotional discretion from critical decisions. Think of it as your trading insurance policy. Boring, but essential for survival. Every rule exists because traders before you got destroyed by that specific mistake. But protocols written on paper mean nothing when your account is bleeding and emotions are screaming for action. Knowing the rules and executing them under psychological pressure are completely different skills. Ready to stress test these bulletproof rules against 3 brutal market scenarios that separate surviving operators from eliminated gamblers. Protocol rules look bulletproof on paper, but markets specialize in psychological warfare that transforms disciplined operators back into impulsive gamblers. Let's stress test your new operating system against 3 brutal scenarios that separate surviving professionals from eliminated amateurs. Same technical setups, opposite outcomes based purely on identity and systematic execution. News whipsaw chaos strikes at 8:25 a.m. EST, 5 minutes before NFP release. EUR USD has pulled back beautifully to a 61.8% retracement that aligns perfectly with yesterday's session high. The setup looks flawless. Textbook Fibonacci confluence that triggers every pattern hunter's dopamine receptors. Gambler sees perfection and clicks buy immediately. This can't miss, his brain screams. Position opens with 3 pip slippage due to tightening spreads. NFP prints hot. Dollar rockets. EUR USD gaps down 40 pips through his stop. Panic mode activates. He watches price spike back up past his entry level and rage clicks a revenge short because I was right about the level. Price consolidates higher, stops him out again. 2 trades, 2 losses, week destroyed in 10 minutes. Classic death spiral triggered by emotional hijacking. Operator's news ban rule prevented entry entirely. No exceptions? No, but this setup looks perfect rationalizations. Post-spike, he waits for volatility to normalize. Clean structure forms 30 minutes later. The 50% retracement now aligns with prior day high and VBWAP confluence. Sniper protocol demands confirmation. Minimum 2 candles after first touch. Micro break of pullback structure confirms buying pressure returning. Mirror rule check. Shorts trapped below the spike low face. Pain above the pivot high. He risks measured 0.75% for clean 2.2R winner as opposing stops get cascaded. Patience transforms chaos into systematic profit. Trending pullback deception unfolds when strong daily uptrend in GBP USD pulls back to 38.2% level that aligns perfectly with rising 20 EMA. Pattern hunters salivate over this obvious buying opportunity, but proper anchoring separates professionals from pretenders. Gambler anchors from wrong swing using 15-minute chart because it creates prettier retracement. Buys first touch because confluence looks perfect. Gets flushed when deeper pullback reaches. True 50% level based on proper higher timeframe structure. Stops out at 1R, then watches price reverse exactly where it should have based on correct analysis. Frustration compounds into overtrading revenge. Operator waits for proper higher timeframe anchor using H4 chart structure. Context check reveals daily trend intact with healthy ATR. He sees that true 50% level coincides with prior breakout base and volume profile node. Real confluence, not wishful thinking. Demands micro higher low formation before entry, confirming selling pressure exhaustion. Trails stops via swing lows as momentum builds, not arbitrary Fibonacci levels. Scales partial profits at 1R. Lets remainder run to 2.8R when opposing shorts get squeezed. Systematic patience transforms identical price action into substantial profit. Midday chop grinder arrives between 11 a.m. and 2 p.m. EST, creating sideways consolidation with constant Fibonacci level touches. Every retracement looks tradable to pattern hunters desperate for action. This is where accounts get destroyed through death by thousand cuts. Gambler takes every signal because doing nothings feels like missing opportunities. Buys 61.8% touch, gets stopped. Shorts 38.2% rejection, gets stopped. Buys 50% bounce, gets stopped. 8 trades, 6 losses, account bleeding through commissions and slippage. Each individual loss seems manageable, but systematic bleeding destroys compounding potential, while emotional tilt guarantees larger position sizes. Operator's chop filter activates immediately. Low ATR, overlapping price bars, lack of directional momentum. All signals for reduced activity. He trades only mean reversion at 50% level with clear rejection wicks and reduced 0.5% risk, or implements complete session avoidance. Doing nothing becomes strategic action that preserves capital for higher probability environments. Each scenario proves identical truth. Same technical setups produce opposite outcomes based on operator discipline versus gambler impulses. The market doesn't care about your lines. It cares about your process under pressure. But here's the deeper psychological challenge. Even bulletproof protocols fail without proper identity anchoring. When your account bleeds and emotions scream, who are you? The brutal market scenarios proved that identical setups produce opposite outcomes based on one critical factor: identity. Your technical analysis skills matter far less than who you are when pressure mounts and emotions scream for action. Consistency is an identity, not a strategy, and most traders fail because they're operating with the wrong psychological operating system. The Fibonacci gambler identity craves certainty in an uncertain world. This identity personalizes every market movement, interpreting price action as validation or rejection of their analytical skills. They seek emotional satisfaction through perfect technical analysis, treating each setup as a referendum on their intelligence. When trades work, they feel genius-level smart. When trades fail, they feel personally attacked by the market. This emotional roller coaster destroys systematic execution because decisions get filtered through ego protection rather than probability management. The market operator identity accepts uncertainty as the fundamental nature of markets. This identity manages probabilities over large sample sizes, finding validation through consistent process execution, regardless of individual outcomes. They understand that being right about individual trades matters less than being systematic about edge execution. Operators treat the market as a teacher providing feedback about process quality, not as an adversary to defeat through superior analysis. Identity anchoring techniques require deliberate rewiring of your internal language patterns. Your brain's internal dialogue shapes emotional reactions and decision-making processes. Replace "this Fibonacci level will hold" with "this level offers favorable risk yet reward if confluence aligns." The first statement creates expectation and attachment. The second maintains objectivity and conditional thinking. Swap. I hope this works with "I'm executing my systematic edge." Transform "the market is against me" into "the market is teaching me about my process gaps." These aren't positive thinking exercises. They're operational rewiring that changes how your brain processes market information. Ritual installation creates behavioral anchors that reinforce operator identity. Establish pre-market intention setting. Review higher timeframe bias. Mark key structural levels. Note high-impact news times. This ritual shifts your brain from reactive pattern hunting to proactive systematic preparation. Implement mandatory pre-trade checklists covering 3C confirmation, mirror rule verification, and position size calculation. Checklists prevent emotional hijacking during high-pressure moments when your gambling identity tries to override systematic protocols. Create post-trade debriefs, examining what worked, what didn't, and emotional state assessment. Rate your patience, discipline, and process adherence on a 1 to 10 scale for each trade. Keep a physical operator card on your desk listing your creed, top 3 if-then rules, and the reminder: no trade is better than a bad trade. Read it before every entry. Boundary protection prevents emotional tilt from destroying systematic execution. Set daily maximum loss at 2R, regardless of setup quality. When you hit this limit, close your platform and walk away. Implement maximum trade count of 3 to 5 per session to prevent overtrading. Establish mandatory 20-minute breaks after any tilt signals. Revenge trading urges, position size increases, or protocol violations. Use P&L hiding software to focus on process metrics rather than dollar fluctuations. When you can't see real-time profit and loss, you focus on execution quality rather than outcome attachment. Resilience building creates psychological durability for inevitable streaks. Develop specific rules for both winning and losing sequences. Success can create overconfidence that leads to protocol violations just as destructively as failure creates revenge trading. Practice breath reset techniques between trades. 4 counts in, hold 4 counts, 4 counts out. This activates nervous system recovery that prevents emotional accumulation. Use a physical token, coin, ring, or bracelet as a tactile reminder to slow down whenever FOMO hits. Cultivate interests outside trading for emotional regulation. Trading can't be your only source of stimulation without creating unhealthy psychological pressure. The gambler seeks entertainment and certainty from market participation. The operator seeks consistency and mathematical edge through systematic execution. This identity shift isn't philosophical theory. It's operational survival insurance that determines whether you'll be trading profitably in 5 years or telling war stories about blown accounts. But here's the psychological challenge nobody discusses. Your new professional approach will feel boring compared to the excitement of pattern hunting and gambling-style risk-taking. What happens when systematic success feels less satisfying than chaotic failure? Here's the paradox that breaks most developing traders. Professional trading feels boring because it lacks the emotional highs and lows of gambling. Your brain becomes addicted to the dopamine hits from perfect pattern discoveries and high-risk entries. When you adopt systematic approaches, the excitement disappears, and that terrifies traders back into destructive habits. This isn't weakness, it's neurochemistry. Your gambling brain has been conditioned to crave the drama, the adrenaline spikes, and the desperate hope of massive wins. Every beautiful Fibonacci confluence floods your system with pleasure chemicals. Every high-risk, can't-miss setup triggers the same neural pathways that destroy gambling addicts at slot machines. When you implement the 3C protocol with measured entries and boring consistency, your brain interprets this as punishment rather than progress. The excitement trap, explained through casino psychology, reveals why systematic success feels unsatisfying. Casinos engineer variable reward schedules specifically to create behavioral addiction. Random wins delivered unpredictably feel more powerful than consistent small gains delivered systematically. Your trading brain seeks the same intermittent reinforcement, making disciplined Fibonacci application feel like switching from sugar rushes to nutritious meals, healthy but initially bland. Think about your most memorable trades. They weren't the systematic 1.5R winners following perfect protocol. They were the chaotic 4R home runs where you broke every rule, risked too much, held too long, and got lucky. Your brain catalogs those outliers as evidence that real trading requires excitement and rule breaking. The systematic winners get forgotten because they don't trigger neurochemical fireworks. Embracing productive boredom requires reframing what success looks like. Professional boredom indicates you're no longer seeking entertainment from your trading capital. It means you've shifted from gambler to operator identity. This boredom is productive because it reflects emotional detachment from individual outcomes while maintaining focus on systematic execution. Boring trading means you're managing probabilities like an insurance company, not thrilled by individual claims, but focused on long-term mathematical edge. When trading feels like running a business rather than playing a game, you've achieved the psychological state that creates sustainable profitability. The house finds comfort in boring, predictable math, not the drama of each individual bet. Managing psychological withdrawal from excitement-based trading requires active replacement strategies. Switch the scoreboard you're watching. Stop measuring thrill. Start measuring process. Create a professional pride board celebrating consistency statistics, consecutive days following protocol, average R multiple improvement, emotional regulation scores. Track your operator rating, percentage of trades executed systematically rather than impulsively. Find fulfillment in process improvement metrics rather than individual trade excitement. Celebrate boring victories. 15 consecutive days following pre-trade checklists. Average loss reduced from 1.2 R to 0.0 R. 0 revenge trades this month. These achievements provide satisfaction without requiring market validation. Develop non-trading interests for healthy dopamine stimulation. Exercise, hobbies, social activities, learning new skills. Your nervous system needs stimulation, but it doesn't need to come from risking your financial future. Physical exercise particularly helps because it provides natural endorphin release while building stress resilience. Create tactical boredom tools. Set a 5-minute timer after every Fibonacci level touch. Practice breath cycles. Read your operator card aloud. Track 3 daily metrics: discipline, patience, resilience, and aim for 7s before increasing position size. When those metrics slip, you're not weak, you're under-recovered, and recovery is part of systematic edge. Small account solutions prove that systematic approaches work better than home run hunting, especially with limited capital. Gamblers with $1,000 accounts chase 50% monthly returns and blow up within 3 months. Operators target consistent 1 to 2% monthly gains that compound dramatically over time. The compounding math reveals boring consistency's power. Future value: match 1,000 forex, so 1 to 15, 48 to 1 to 956, whose future value: 1,000 to 9x, 1 to 15. 48, mine 4,956. The $1,000 becomes 1,956 in 48 months without additional deposits, nearly doubling through systematic 1.5% monthly returns. Small accounts benefit more from this approach because they can't absorb the variance that home run hunting creates. Consistent base hits keep you in the game long enough for compounding to work its mathematical magic. This is the tortoise and hare principle played out in your trading account. The gambler chases 50% weekly gains, blows up, redeposits, and repeats the cycle, never actually growing their base. The operator compounds boring consistency into life-changing wealth over time. Boring consistency beats exciting inconsistency every time because mathematics doesn't care about entertainment value. Excitement is the enemy of consistency, and consistency is the foundation of wealth building. When your trading feels like punishment rather than entertainment, celebrate. You've achieved the psychological state that separates survivors from casualties. Ready for your final operating manual that synthesizes everything into an unshakable daily practice. Time to synthesize everything into your new professional identity. The psychological warfare is real. Your gambling brain will fight this transformation because systematic success threatens the excitement addiction that's been destroying your capital. But survival demands evolution, and evolution requires abandoning comfortable delusions for uncomfortable truths. The market operator's creed contains 4 unshakable pillars that define how you approach every Fibonacci setup, every emotional hijacking attempt, every moment when your old identity screams for impulsive action. I trade probabilities, not predictions. This destroys the fortune teller fantasy that ruins retail traders. Fibonacci levels highlight potential areas where order flow might react, never guaranteed outcomes demanding blind faith. You assess probability based on confluence, context, and confirmation. Never certainty based on mathematical ratios. When you see that perfect 61.8% retracement, your brain doesn't whisper, "This will hold." Instead, it asks, what's the probability this offers favorable risk-reward given current market structure? Prediction creates attachment and disappointment. Probability management creates sustainable edge. I manage risk, not outcomes. Your edge doesn't come from being right about market direction. It comes from position sizing that preserves capital during inevitable losing streaks, stop placement beyond meaningful structure that limits damage without premature shakeouts, and expectancy management that ensures positive mathematical results over large sample sizes. Individual trade outcomes are random events in a probability distribution. Systematic risk management creates long-term profitability by controlling what you can control while accepting what you cannot. I execute systems, not emotions. Your 3C protocol, mirror rule, and sniper protocol exist specifically to override fear, greed, and hope when they hijack rational decision-making. Emotional impulses become data points to observe and journal, not commands to follow with your trading capital. When FOMO screams, "Buy this perfect bounce now," you observe that impulse, note it mentally, then execute your systematic checklist regardless of internal pressure. Process first, feelings second, always. I compound consistency, not chase perfection. Small systematic edges compound into significant wealth through the mathematical miracle of consistent execution. Chasing perfect setups destroys consistency through overtrading, emotional interference, and inevitable disappointment when perfect setups fail. Your edge comes from executing hundreds of good enough setups systematically, not finding dozens of perfect setups emotionally. Perfection is the enemy of consistency, and consistency is the foundation of compounding wealth. Daily implementation routine transforms philosophy into tactical survival. Morning intention setting, review your creed aloud, check higher timeframe bias, mark 2 key levels above and below current price, note high-impact news times, and set your DOC2R maximum daily loss limit. Pre-trade checklist becomes non-negotiable. 3C confirmation, mirror rule verification, position size calculation using your systematic 0.75 1% risk percentage, and emotional state assessment before clicking anything. Post-trade documentation captures lessons while fresh. Confluence factors present, protocol adherence rating, emotional state during execution, planned versus actual are multiple, and one specific improvement. For tomorrow, evening review synthesizes the day. What worked, what didn't, emotional regulation successes and failures, and concrete preparation for tomorrow's session. The Fibonacci operator's mantra provides instant psychological anchoring during high-pressure moments. Fibonacci shows me zones. Context tells me when. Confluence tells me where. Control tells me how much. Consistency tells me who I am. Memorize this. Repeat it before every trade. Let it override emotional hijacking when perfect setups appear and gambling impulses activate. This isn't about becoming a perfect trader who never loses money. That fantasy destroys more accounts than bad analysis. This is about becoming a surviving trader who stays in the game long enough for mathematical edge to compound into life-changing wealth. The house doesn't win every hand, but it wins systematically through disciplined execution of small edges over thousands of transactions. Your choice is binary and permanent. The gambler's path of excitement, entertainment, and inevitable account destruction, or the operator's path of systematic boredom, consistent execution, and wealth building that transforms your financial future. But knowing the creed and executing it under fire are completely different challenges. Ready for your final 30-day transformation protocol that turns these principles into unbreakable habits? This isn't a casual choice between trading strategies. It's a survival decision that determines whether you'll be building wealth or telling war stories about blown accounts 5 years from now. The statistics are unforgiving. 80% of retail traders lose money consistently, not because they lack intelligence, but because they operate with gambling identities in probability-based markets. Continue the Fibonacci gambling approach and face inevitable account destruction, plus psychological damage from repeated failures. Adopt the operator identity and build sustainable mathematical edge that compounds over decades. Your 30-day transformation protocol converts theory into unbreakable habits. Week 1. Install the 3C protocol exclusively on demo accounts or micro positions. No live trading exceptions. Focus purely on context identification, confluence assessment, and control execution without money pressure corrupting decisions. Document every emotional impulse to trade live during this foundation week. Week 2. Add mirror rule and sniper protocol while maintaining detailed journals. Before every entry, articulate where opposing traders get squeezed. After every Fibonacci touch, enforce the mandatory 2-candle or 10-minute confirmation wait. Rate your patience development on a 1 to 10 scale for each setup. This builds the discipline muscle that separates operators from gamblers. Week 3. Implement full risk management system with daily maximum loss, (2R), and weekly limits, (5R). Create physical stop trading cards to place over your mouse when limits get hit. Install P&L hiding software to focus on process metrics rather than dollar fluctuations. This week proves you can follow rules when they hurt. Week 4. The psychological crucible. Focus purely on process metrics while ignoring profit-loss outcomes completely. Your brain will desperately crave outcome validation. Resist. Measure only execution quality, protocol adherence, and emotional regulation. Perfect compliance this week predicts long-term survival, better than any winning streak. Process metrics replace outcome addiction with systematic improvement. Track percentage of trades following complete 3C protocol. Target 90% adherence before increasing position sizes. Measure average time from signal to entry, monitoring patience development. Correlate confluence factors with outcomes to identify your strongest edge combinations. Rate emotional regulation daily on a 1 to 10 scale, targeting consistent 7s before advancing. Community integration accelerates identity transformation. Connect with traders making the same shift from gambler to operator. Share process improvements and systematic insights. Never trade bragging or profit screenshots. Support others struggling with excitement addiction. Teaching reinforces your own learning. Choose environments that reinforce systematic thinking over gambling excitement. The 2 numbers and 1 habit that outperform any golden ratio. Number 1 is your fixed risk per trade. Exactly 0.75% to start, never modified because a setup looks perfect. Number 2 is your mandatory daily circuit breaker at 2R maximum loss that preserves capital and prevents tilt spirals. The habit is rigorous post-trade journaling with screenshots, confluence checklists, and protocol adherence scores. These boring elements quietly convert chaos into compounding because they control exposure, prevent emotional hijacking, and create continuous improvement feedback loops. Market as teacher reframe eliminates adversarial thinking. The market isn't your enemy to defeat through superior analysis. It's your teacher providing continuous feedback about who you are as a trader. Every Fibonacci level tests your discipline. Every confluence decision tests your patience. Every loss tests your resilience. Ask after every trade, what did this teach me about my process gaps? Your final binary choice arrives with every setup. When the market puts a perfect-looking Fibonacci retracement in your face, will you click like a gambler seeking excitement and validation? Or will you pause, assess systematically, and execute like an operator managing probabilities over large sample sizes? Choose survival over entertainment. Choose the house edge over the player's hope. Choose discipline, patience, and resilience over hope, fear, and greed. Accountability. Implementation. Write the operator's mantra on a sticky note and post it near your screen. Share your 2 numbers and 1 habit commitment with someone who will hold you accountable. Create weekly voice note check-ins with a trading partner focusing purely on process adherence, not profits. The tools are in your hands. The mathematical proof is undeniable. The choice is yours. The market is waiting to teach you exactly who you really are when money and emotions collide.